In 2020 and 2021, there's been a significant increase in the use of special purpose acquisition companies known as SPACs. SPACs also have been called blank check companies. SPACs are a way for private investors to take a company public without the wild price swings that may occur during an initial public offering. SPACs, even though they've been around in one form or another since the 1990s, are now particularly in vogue for private equity investors and, oddly, celebrities looking for a place to invest their significant cash stockpiles. Here's the way a SPAC generally works. A sponsor group creates a newly organized company and takes it public without that company having any existing operations. In fact, a SPAC often exists solely to receive investments to fund the acquisition of a private operating company that the SPAC's management will go out and find. These investments are placed in a trust fund and can only be used for the purchase of an operating company. SPAC investors, therefore, are really investing in the capacity of the SPAC management team to find and close a deal on a suitable private company. Most SPAC governing documents say that the SPAC has between 18 and 24 months to find and purchase such a company with its investors' money. If it doesn't, however, the SPAC must often return all the money in the trust to its investors. So, as a person selling their private business, there are several advantages and disadvantages to private business owners selling to a SPAC. On the positive side, the valuations that are being paid by SPACs in mid-2021 tend to be significantly higher than the valuations paid by equity funds and strategic buyers. The valuations paid by SPACs have been so high, in fact, that in February 2021, Berkshire Hathaway's vice chairman Charlie Munger said, "Crazy speculation in enterprises not even found or picked out yet is the sign of an irritating bubble." Of course, most private business owners that I know are fine with the thought of being bought out for an unreasonably high valuation. On the negative side, business owners who sell to a SPAC need to be immediately ready to meet the requirements of operating as a publicly traded business. These requirements include audited financial statements that meet public company GAAP and SEC rules, interim financial statements, Form S-4 proxy statement, Form 8K disclosures, and compliance with insider trading rules. In addition, private business owners will generally be required to sign a lockup agreement preventing them from selling their stock in the newly public company, typically for a 6-month period. This tends to be a real issue as almost all of the business owners I work with to help sell their companies in a more conventional manner insist that a significant portion of the purchase price be paid in cash at closing. There are upsides and downsides to selling your business to a SPAC, but it's definitely a process that business owners need to go into with both eyes open.